Alright, so another lesson. Today we're going to talk about capital gains tax and why it's important. Okay, capital gains tax is basically a tax on any gain that you would make from selling a security or anything. Sell a house, sell a t-shirt, sell anything you sell for a profit, considered a capital gain. Okay, but for today we're just going to talk about stocks. Alright, so what is a capital gain? Alright, capital gain is any time that you have the price of something that you sell it at is greater than the initial price, so the price that you bought it at. So it means that if you sold something, you bought something at one price, it went up, you sold it, that is a capital gain. Okay. For example, if you have a diamond ring that you buy, $5,000, a year later you sell that for $6,000, you therefore would have a capital gain of $1,000. All right. And capital gain tax means that you would be taxed on that $1,000. You won't be taxed on the full $6,000 that is valued at. You'll be taxed on just your profit. So in terms of stocks, if you buy a stock at $1, it goes to $2, you'll be taxed on that $1 profit. Okay? All right. And there are guidelines as far as how much you'll be taxed. It depends on which federal tax bracket you fall under. Starting January 1st, 2011, there will be 5 different tax brackets: 15%, 28%, 31%, 36%, and 39.6%. Okay? Right now it's a little bit different, and the tax brackets are different. So like I said, starting January 1st, you'll see this sort of a tax bracket. Now, it also depends on how long you hold it for. So if you hold it for less than a year, you'll be taxed at 15%, 28%, 31%. Basically, you can see you'll be taxed at your same federal tax bracket amount. Okay? If you hold a stock for less than a year, you'll be taxed at the same amount at whatever tax bracket you fall under. Now, if you hold it for 1 to 5 years, it's a little bit more of a discount there. 10%, 20%, all down the rest of the line is 20%. So if you look at it, you can see that there's a pretty good break that you'll be cut if you're in a higher tax bracket. What that means is that if you make a lot more money, which is why you be in this higher tax bracket, you don't have to pay as much in relation to how much it's worth or how much you have there as someone who makes less, which really doesn't make that much sense, I guess, but that's a whole other conversation, a whole other argument for another day. Alright, so basically you got capital gains that you would have to pay on anything that you make money off of. If you go to the casino, you should be paying capital gains taxes on any winnings from there. If you sell something on eBay for a profit, you should be paying capital gains tax on that as well. If you don't report it, and you take a chance of getting audited or whatever, it's a big mess, go to jail, I don't know. But it's better to report it, no matter what it is, okay? It's good to know these amounts, because that way it can help you if you ever, let's say you make a lot of money in the stock market, okay? What's stopping you from just going out and spending that money on a car or whatever? You have to keep in mind that you're gonna be taxed on that money. You have to keep in mind that you're gonna at least set aside enough to be taxed, to cover your tax. All right. So something like that can get you in trouble if you take the winning from a profit from the stock market and just splurge or whatever. You have to pay for it eventually. All right. So that's capital gains tax in a nutshell. Next video I'll talk about just a little bit more about why it's so important and different ways of cheating the system. All right. All right. Peace.